Hey everybody, this is Greg Gossett from Gossett Trading and Mentoring, and today is Saturday, October 21st, 2023. How you doing? Appreciate you coming to my weekend review podcast. I hope you had a good week. Boy, what a week in the markets. Lots of volatility and lots of turmoil. And in this podcast today, what we're going to do is we are going to take a look at all the trades that I made last week. We're going to talk about when I bought the position, what the entry was, which signal I was using, and most importantly, as always, how I am going to manage the position going forward, either to the upside or to the downside. It's very important in trading that you have a process. You know what your signals are um, of when to get in the position, what the strategy is. It should be a good risk to reward ratio. You should position size correctly based upon your account value vis-a-vis the current market volatility in the market. You should have an emergency stop so you know exactly in the worst case scenario that you're going to only lose a certain small percentage of your account. I just mentioned risk to reward ratios. You should have an end of day stop or an end of week stop depending on the time frame that you're trading, where if you're wrong quickly and you're wrong out. The way that I trade, if it moves my way, I take a certain percentage of my account off at each level, and that is a 0.45 level based upon the previous bar's close. I have a trailing stop level that if I get to that trailing stop level, now I go in, now I tighten up my stop. So if it does go back against me, that I will get out of half my position if I have a close below a previous bar's low. When we get into overbought levels up into the 65 RSI level, then if we close below the 5 EMA level, I'm completely out of the position. If we reject the 70 RSI level, I get out of half the position of the shares that I have remaining. And then if I get a close below a previous bar's low after rejecting the 70 RSI, then I'm out of the entire trade. I know it sounds like a lot of rules, but in trading you need to have a process that takes everything into account. What's the volatility? Where are my two stops? Taking partial profits, knowing when to take something off if the market starts to move against you. You just need to have a process. You need to have if then statements. If this happens, then I'm going to do that. If that happens, then I am going to do this. And most importantly, big picture, you need to be very impatient with your losers and very patient with your winners. So if you want to become a successful trader, a profitable trader, a full-time trader, you need to have a complete plan in place. And that is what I'm going to try to show you today in this podcast. All right, so we'll take a look at the positions, when I bought them, why I bought them, how I'm going to manage them going forward. I have trades both on the daily time frames and the weekly time frames, and you'll notice that I have both winning and losing trades, but you'll notice the winning trades I'm in for could possibly be a significant amount of time because they're winning trades and I give them some room to breathe. If they're negative trades, if they're losing trades, I am out really quick. And just this one concept, I really think will help you, will help every trader. Be very impatient with your losers, be very patient with your winners. And if you get out quickly on a loss, you can always get back in if you get back above that level. The way that I look at trading, I look at certain levels, certain oversold levels. If I'm trading in deep dip buy approach, 250-day moving average, 300-day moving average, 300-day moving average, 30 RSI. And I like to see the market reject those levels. If it's rejected that level, that gives me a good piece of intelligence to go, okay, there were no more sellers under that level. Doesn't mean the next day or in the future that they can't go down below that level, certainly, but it gives you a good start to a trade. All right. So after we go through the trades, we're going to talk a little bit about trader psychology, always the most important part and the most important skill in trading, because it really is a skill in trading, is the ability to follow that plan. First, you have to create a plan, then you have to follow the plan, right? And by the way, if you're new to trading or if you're having a challenge with trading and you don't really have a process on what to do with your trading, I do offer private one-on-one lessons in the evening time via Skype. I've taught people from all over the world, from absolute beginners to high-level hedge fund managers. If you're looking for a process, I can help you with that. And I would love to teach you. I've been trading for over 28 years, and like I said, I've taught many students across the world, and I can teach you a trading strategy that uses good fundamental trading principles, and you'll be a better trader, I promise. And so my email's in the link in the description. If you're interested, please reach out to me. So after trading psychology, I have down through my master watch list, both on the daily time frames and the weekly time frames, and I'll show you what I am looking for next week. And after this big sell-off, because of the Middle East conflict, and Powell spoke this week, we are starting to get to some interesting levels that give good risk to reward ratios. It doesn't mean that they're going to be winning trades, but it does mean that it's a good, we're coming to a level where there's some good setups that offer us a good risk to reward ratio based upon a rejection of a major level. And a lot of stocks, a lot of markets are getting to those major levels. And so, if I have a rejection of a major level and it's good risk to reward ratio, I am going to take the trade. It doesn't matter whether the sentiment in the market is very bearish, which it is right now. There's a lot of fear in the market. There's a lot of negative sentiment. But when you go back and you look at these times when there's been a lot of negative sentiment, that's usually the time to buy. Okay, so there are some good opportunities here. Of course, we still need to stick to our processes, and if we're wrong, get out quickly. But right now, I feel like there is a good opportunity for some potential setups. So both on the daily and the weekly, I have identified some interesting setups. And as always with setups, you will skew the odds in your favor if you have multiple setups, multiple confluences and combinations of indicators lining up. Example, rejection of the 200-day moving average. In addition, you have a V1 entry signal as well. In addition, the charts on the higher time frame. For example, if you're trading weeklies, the charts, dailies, the charts on the weeklies have some kind of support as well. And, in addition to that, another confluence or combination could be just the relative strength of the market. I got long Home Depot yesterday on a weekly trade, and what pushed me over the edge on that particular trade was the fact that it was barely down on a day that was quite red. All right, so it's important to have confluences, combinations of indicators lining up, and I will describe more of this as we go through. But there are some good opportunities. I have identified some good stocks that really are on sale now. Stocks are about the only thing that people don't like to buy on sale. They like sales on jeans or cars or anything else when they're on sale, but for some reason, a lot of retail traders don't want to buy something when it's down. Because why? Because it's scary. But it's always best to buy something on sale, right? So anyway, we'll go through those both on the daily and the weekly, and I'll show you what I'm looking for. And okay, so that's what we're going to do today. First of all, before I start, I have to run the U.S. legal disclaimer, so hang tight for about 40 seconds, and I'll be right back. Thank you.
This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Please carefully read and/or listen to the U.S. government required disclaimer before watching this video or live stream broadcast. The video link and disclaimer text are located in the description section of this video or live broadcast, here and here. Thank you so much.
All right, let's get started. First on deck, these are the daily trades now, by the way. AMD. All right, I bought AMD all the way back here on the 25th of September. Why did I buy it? Well, The black line here is the 200-day moving average. This is a key level. This is where a lot of large financial institutions and experienced traders will key their trades off of. And I got long here because during the day, this is the main reason I bought it, but I'll show you why there were some additional signals that made the trade look even better. But during the day, it was below the 200-day moving average. But at the end of the day, it closed back above the 200-day moving average. My entries are all based upon the close of the market because the closing price is the most important price in my opinion, because the large financial institutions come in, they take control of the market at the end of the day. So you can see during the day, yes, it was below the 200, but at the end of the day, we closed almost near the high and we closed above the 200-day moving average. So that was my entry signal. In addition to that, we had a V1 entry trigger. Now a V1 consists of two bars, bar 1, bar 2. Bar 2 went below bar 1's low, or in other words, it washed out the low, but then closed above the close. This adds a lot of value to the trade, in addition to the main core entry signal of being the rejection of the 200-day moving average. And by the way, if you want to learn more about V1s or V2s, I have a video on YouTube. Just go to my YouTube channel in the lessons playlist, look for V1, V2. I also believe it's in the description of this video as well. V1s, V2s, big part of my trading. And of course, in my one-on-one courses, I teach it. But you can watch a nice free video on YouTube. Just look for V1s, V2s in my channel. So that was the signal. That is why I decided to buy it. I want to have the support of the 200-day, which is the black line, below me instead of above me, right? Because it acts as support. So intraday rejection of the 200-day moving average, a V1 entry signal. Those are the confluence of the signals. I got long here 96.60. I position size. Now, talking about position size is very, very important and very often overlooked. The way that I position size, it's all based upon your account value. So let's just use a hypothetical $50,000 trading account today. $50,000, what I do, now if it's 100,000, it's you're going to times it by 1%, you get 1,000. But I take whatever capital I have, let's just say it's $50,000 times 1%. How much is that? Well, that's $500. So I know exactly that my maximum allowed loss on this trade is going to be $500. So I take whatever my capital is, times it by 1%, in this case it's $500, divided by the value of the 2ATR. 2ATR is just 2 times the average true range, divided by 7.25. It shows me that based upon my account value, that I should buy 68.9 shares. So I have to round that up to 68.9 shares. I should round that up to 69 shares. So that for a $50,000 account, based upon the current market volatility, this is the correct amount of shares that I should buy, 69 shares. Now, always important to talk about defensive moves or stops first. So I know I'm going to buy 69 shares. I know that the average true range was 725. So I take my entry price minus 725. That is the red line below me. This is exactly $7.25 below my entry. So if I have 69 shares and it gets down to my maximum allowed loss here, my emergency stop, in other words, $7.25 below my entry, then I know I'm going to lose $500, right? If I have a $100,000 trading account times 1%, it's 1,000 divided by 7.25. It would be twice 69. And then I know that would be my maximum allowed loss. Now, your maximum allowed loss does not happen frequently. It only happens about 5% of the time. But it's a nice feeling to know exactly, okay, this is in the worst case scenario, this is how much I know I'm going to lose. And by the way, I mentioned I base everything upon the closing price except for my emergency stop. If it ever hits my emergency stop, which is 2 ATRs below my entry, now I know how much I've lost, but I will always take it immediately. Doesn't matter if it's 1 minute after the market opens or 1 minute before the market closes. I don't wait for the end of the day on this, but my end of day stop, yes, I wait for simply a close below the 200. And if it, you can see that after I bought it, the next day it went down, but you see how it held and it closed above the 200-day moving average. So I stayed in the trade. If it had closed below the 200-day moving average, I simply would have gotten out for a very small loss, even if it closed here. Not going to be $500, right? Because 500 is our maximum allowed loss. So even if I have a loss anywhere in here, it's going to be less. And that's the key, is keeping your losses small. So, all right, so that's the setup. That's my position sizing. We have the two stops, emergency stop, 2 ATRs below, end of day stop, close below the 200-day moving average. So we've got that taken care of. Now let's talk about the upside. I'm always going to place, once I enter, I'm always going to place a 1.5 ATR trailing stop level above my entry. So we have a 2 ATR emergency stop below entry. I have a 1.5 ATR trailing stop level above. So once I get to that level, now I'm in what's called trailing stop mode, which means that now in the future, once I get to this 1.5 trailing stop level, now in the future, if I get a close below a previous bar's low, then I'm going to take off half of the remaining position that I have. All right. Because in order to come back down, most likely you're going to have to get a close below a previous bar's low. So this is an anticipatory way to reduce risk. So, okay, intraday rejection of the 200-day moving average, position size, trailing stop level, 1.5 ATRs above. And then before we get to the rest of the trade, I always take partial profits, 10% of the remaining shares that I have if the price moves the value, and this changes every day, of 0.45 ATRs from the previous, from the last day's close. So example, right now we're at 101.81. This is the current price on AMD. I would take 101.81, add the value, $1.63 to the closing price, whatever that is, that's going to be my first profit target. Then I'm going to take my first profit target, add this again, that's going to be my second. I'm going to take my second profit target, add it again, that's going to be my third profit target. And I do that every single day because I like to take partial profits as the market gives them to me. The trailing or the emergency stops, the end of the day stops, the close below a previous bar's low after reaching trailing stop level. These are all defensive moves, but I want to take some offensive moves as well. And the offensive move is to sell a partial partial portion of my position on the up moves. That's the offensive. So again, intraday rejection of the 200-day moving average, V1, position size, emergency stop, end of day stop, know where my trailing stop level is. And so here I bought, the next day it went down, but it did hold the 200, kept me in the trade. Next day it moved up. I took some profits. Next day moved up big. I believe I took 2 or 3 profits at this point. Now I also got to trailing stop level here. So now in the future, if I get a close below previous bar's low, I will exit half the remaining position. Well, that happened here on the 3rd of October because we reached trailing stop level and then we have a close below a previous bar's low. I got out of half of the remaining position and locked in a gain of 3.54%. And then we were off to the races again. Next day went up, hit profit targets. Next day didn't do anything, no profit targets. Next day moved up strongly again, took another 2 profit targets off. Then we moved here, nothing burger, didn't do anything. Moved up again, took some more profits here. From here to here, took another profit target right at the top. And now last week, of course, we had the big move down. So am I glad with the current price right now that I took profits here and here and here and here and here? 100%, because it reduces my position size and I get out of some at the very top. And if you use this partial profit method, the 0.45 partial profit method, just by default, if you have a big move up, you will always get some near the top. So am I glad that I took off up here and up here and up here and up here? I absolutely am. And now we've had this big move down. So am I still in the trade? Yes, I'm still in the trade. Why? Because it's still holding the 200-day moving average. So current, with the remaining shares I have on this position, up 5.1%. So not a bad trade. VIX. All right, so if you've been watching this channel, I did mention, more than a week ago, actually, yeah, I've been mentioning it for a couple weeks, that I was looking to buy VIX if we came back into this green area. Why the green area? Well, this is what's called a fair value gap. And if you'd like to learn more about fair value gaps, and they're a very strong signal, look up ICT on YouTube. As a matter of fact, one of my students, Ava, is the one that taught me about fair value gaps, and they are very, very strong. So in general, you need to have a level of liquidity. Here's a level of liquidity, basically just a low that gets run. So here's your level, went down. Then I look to the left for my first swing high. That's here. Once we move strongly and emphatically above that, now we have changed market structure. And when you change market structure, you'll have these things called fair value gaps. And I'm not going to go into detail because it really kind of takes a lot of time to really get this. But in essence, we had a fair value gap from this low to this high. The market never came back. It just went right through it. It never tested these levels. And so if it comes back into the gap, that's your entry. Well, you can see we changed market structure. We came back into the gap and off to the races. So it's definitely possible that it could come back into the value gap again. And that's right around here. I was saying that if VIX comes back into the gap, I will get long. And on this particular day here, it went into the gap, closed back above the gap. And look, here's the V1, bar 1, bar 2. Bar 2 goes below bar 1's low, closes above bar 1's close. That was my entry signal. My end of day stop, my position size emergency stop, which is, remember, 2 ATRs below. My end of day stop, because it's a V1, is simply a close below halfway of the V1. Here's the V1 bar, top, bottom. Here's halfway. Place my 1.5 ATR trailing stop level above. I bought it here. Next day, huge day up. Of course, I took partial profits, right? I think I hit 2, maybe 3. Also got to trailing stop level, which means now if I have a close below a previous bar's low, I'll get out of half. Went down. Here, we went below the low, but closed above. That kept me in the trade. And then the last few days, we've just been up. Again, took profit targets here, took profit targets here. I don't think I hit a profit target on Friday. Now, we're at 61.57 RSI. If we get to a 65 RSI level, now the 5 EMA will come into play, meaning if I get a close below the 5 EMA, I will get out of out of all of the position. Conversely, because we are at trailing stop level, Monday, if we close below a previous bar's low, I will get out of half. If we continue to move up and reject the 70 RSI, I'll get out of half, and then if I get out of half after rejecting the 70 RSI, if I get a close below previous bar's low, I'll be completely out of the trade. So this has been a very good trade, especially in light of what's going on in the market. This particular trade right now, the remaining shares up 14.63%. So pretty good. Pfizer. Now, Pfizer has not been a great trade, but I was in the trade and I got out of the trade as soon as my signals told me to. I got into Pfizer here 32.74. Why? Well, the valid signal was the day before because we have what's called a higher low V2. And the rules for a higher low V1 or V2 means that you have to close below the value zone. The value zone is anywhere in between these two green lines. We certainly closed below. We came into the value zone, we pulled back, and then we had a V2. Bar 1, bar 2, bar 3. Bar 2 washed out bar 1's low. Bar 3 closed above bar 1's close. I didn't get into the trade here, but I got into the trade the next day because it was better pricing and it was very, very close to my end of day stop. If you have a V1 or a V2, your end of day stop is just simply a close below halfway of the washout bar. Here's the top of the bar, here's the bottom of the bar, halfway right here. So I got in here 32.74. I position size correctly based upon the volatility. I placed my emergency stop 2 ATRs below. I placed my trailing stop level 1.5 ATRs above. And then what was that Wednesday? It just collapsed. Look, it didn't get to my trailing stop level, so I didn't lose the maximum allowed. I lost less than that, but I was thinking here, whoa, I might hit my emergency stop. But again, you're only going to hit your emergency stop about 5% of the time. But still, pretty big down moves, 4.17%. But am I glad that I got out here? You could definitely talk yourself into, oh, this is too low, I'm just going to hold it. Well, good thing I didn't, because look, we've moved down significantly from there. So this was a losing trade, 4.17%. All right, let's go over to the weekly trades now. Now remember, weekly trades, your trigger will be on a Friday, because weekly trades, the bar closes on Friday. So here's Apple. I bought Apple here at 175.30 on the 6th of October. What was the setup? The setup is called a return to value V1 or V2. Again, here's the top of the value zone. Here's the bottom of the value zone. We went above the value zone. Don't want to buy above value. Came into the value zone. Closed back above. Came back below. Now we have sideways motion and a V2. V2, 3 bars, bar 1, 2, 3, 2 goes below, bar 1's low, 3 closes above, bar 1's close. Got in here, 175.30, I position size, I placed my emergency stop 2 ATRs below, and where is my end of week stop? In this case, it's halfway of the washout bar, top, bottom, this is halfway. Did we close below halfway? No, we didn't. So I'm still bullish, I'm still in the trade. This particular trade is down at this point, 1.44%. Next week, if we close below halfway, I'm simply out of the trade. My emergency stop all the way down here. Keep in mind, even if it comes all the way down here, worst case scenario for me, I'm only going to lose 1% of my account. Not fun, but it's not going to destabilize your account. You can recover from that, and that's what's key. All right, so currently down 1.44%. Gold, well, excuse me, gold's been a very good trade for me over the last 2 weeks. I entered down here at 169.70. Why would I enter down here when everything looks so bearish? Well, just simply look at the black line. The black line here is the 200-week moving average. This is my level. During the week, we went below. At the end of the week, we closed above. Now I have that 200 below me. It doesn't mean it can't continue down, but at least I have the support below me. So I entered here, 169.70. I position sized. I placed my emergency stop 2 ATRs below. In the future, after I bought it here, if the next week had closed below the 200, what would I have done? I would have simply gotten out of the trade, but it didn't. It went my way. I placed my 1.5 ATR trailing stop level here. Next week, huge move up, hit 2 profit targets, took those off, put those in the bank. Market can't take it away from me. I reduced my position size, so I've reduced my overall risk. And again, this week, again, gold just skyrocketed. And of course, I took partial profits into the strength. So this particular trade is currently up 7.4%. Not bad. We're at a 57.77 RSI. If we go higher and we get above the 65, or we get to the 65 RSI level, then the 5 EMA will come into play. And if it closes below the 5 EMA, I will just get out of all of the remaining shares that I have. Conversely, if it continues to move up next week, as always, I will take partial profits into the move. If we get to a 70 RSI level and reject, then I will sell half. And then if I do sell half based upon the rejection of the 75 RSI level, and then I get a close below previous bar's low, then that is the end of the trade. So this particular trade up very nicely, up 7.48%. XLF, All right, I've been in this trade for a long time. So if I'm in a trade for a long time, what does it mean? It means that it's positive. You're never going to see me in a trade for a long time that's negative. So here we go. Here's XLF. I bought XLF all the way back here on the 24th of March. Why? Well, here we go. Here's the purple line. This is a major moving average. This is the 250-week moving average. During the week, we tested it. We went below it. We closed above it. So I said, okay, and there's a V1. Bar 1, bar 2 goes below bar 1's low, closes above bar 1's close. So there's the confluence of signals. We also rejected the negative third ATR channel, which is important. 92% of prices, when they get to the negative third ATR channel, they stop going down or they bounce and go up. But not all the time, about 92% of the time. So that was my signal. Rejection, intra-week rejection of the 250, got long here, 30.71, position size correctly, placed my emergency stop how far below? 2 ATRs. Placed my trailing stop level how far above? 1.5. Next week, we went up. I took some partial profits. Next week, nothing. Next week, moved up, took some partial profits again, reduced position size. Now we got to trailing stop level, which means if I get a close below a previous bar's low, I get out of half. Next week, we moved up a little again. Nothing. This week, the next week, we went below, but we did not close below a previous bar's low. Next week, did not close below a previous bar's low. Never closed below a previous bar's low. Then we had a little bit up move, took some profits. This was the first bar that closed below the previous bar's low. I got out of half of the remaining shares with a gain of 6.4%. Then we had a nice month rally that I continued to take partial profits off. Took some partial profits here, took some partial profits here, took some partial profits here. In hindsight, that was a really good place to take partial profits, wasn't it? And then we had a move down. We had a slight move up where I took a little bit more partial profits. And then, of course, the last month in the financials have been horrible, and we've just moved down, 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 down. Am I still in the trade? I am, because it's still above the 250-week moving average. But you see how important it is to take those partial profits when the market gives them to you? All right. So it's a bad week, down 3.04% on the week, but still the remaining positions that I have up 4.66%. And then last but not least is Home Depot. Home Depot is a new trade that I entered on Friday. Why did I enter it? Well, look, 200-week moving average, black line here. During the week, we went below it, closed above it. Let's look at the higher time frame. Higher time frame right now in the value zone, which is good. We're not exactly on any level on the week, but we have the 50-week underneath that could act as some support. But you know, the main reason I look to the higher time frame to see if there is support to enter the trade. But in this particular case, again, I took the trade on the weekly, but I looked to the shorter time frame, the daily, and what did I see? Well, I saw an intraday rejection of the 30 RSI. See how we're at 30.05? During the day, we were below 30 and then closed back above it. So, and in addition to that, we have a double bottom bullish divergence. This is something that I teach in my one-on-one course. And I studied one-on-one with Dr. Alexander Elder, and double bottom bullish divergence, in his opinion, is the most important technical signal there is in trading. And let me just quickly cover that with you. Double bottom bullish divergence. Look at this low here. You see the deep red MACD bars? These are momentum bars to the downside. Strong momentum. The deeper these are, the stronger the momentum. Very strong momentum to the downside. Then we rally into green. You can see we got green. But now we are now lower than this low. Would you agree? We went lower than over here. But you see how there's just a little tiny speck of red? That means, from a MACD perspective, that this move down here, even though it looks dramatic, from a MACD perspective, there's not a lot of momentum. Or in other words, what it's really saying is that the selling is drying up. The sellers are drying up, and the implication is if you have your selling drying up, that you're going to head back up. So a lot of different things here. Interesting trade. Main signal was simply the rejection of the 200-week moving average. And like I said, usually I look to the higher time frame for a level, but in this case, the shorter time frame got me interested in this trade with the intraday rejection of the 30 RSI and the double bottom and the bullish divergence. And in addition to, like I said, I'm always looking for confluences, combination of indicators. And V1s, V2s, double bottom, bullish divergence, ATR divergences, RSI divergence, which this also has RSI divergences. Let's take a look. Look at the low here. Look how low the RSI was. Now we're lower. See how much higher it is? ATR divergence. Here we got to the -5 ATR channel. Here we're lower. We're only at the -2 ATR channel. These are strong, strong signals. But in addition, I look for other type of signals. And look, Home Depot on the day was only down 36 cents. It was down 36 cents when the market, the Dow was down double digits, or triple digits, excuse me. And so this is telling me something. Yes, in sympathy, it was down with the rest of the market, but not much. So that's really what got me into this trade. So going forward, next week, of course, I have my emergency stop, 2 ATRs below. If it gets there, I'm only going to lose 1%. If next week it closes below the 200, I'm simply going to be out. If it moves up next week, the value of 0.45 ATRs, I'm going to get out of a profit target. Simply just take the close, 286.41. Right now, the 0.45 is 526. So at 286.41 to 526, whatever that is, that's going to be my first profit target. I'm going to have a second profit, third profit target. Here's my 1.5 ATR trailing stop level. If it does move up next week, I will simply, and it gets to my 1.5 ATR trailing stop level, then if I have a close below previous bar's low, I'll just sell half. By the way, earnings coming up here on the 14th. I never hold through earnings. So regardless of whether I'm up, down, sideways, whatever, I will get out before earnings. So this particular trade is currently up a smidge. Looks like 0.32%. So real quick recap on the daily trades. AMD up 5.01%. VIX up 14.63%. Pfizer closed out for a loss of 4.17%. Apple down 1.44%. Gold up 7.48%. XLF up 4.66%. And then Home Depot up 0.32%. So, we're always going to have losses, everyone, but the key is those losses need to keep small. You can have as big a wins as you want. Obviously, you can have small wins. That's fine. You can have break-even trades. You can have small losses. These are all acceptable. You just can't have the large losses. And, if you watch my positions, you will see you're rarely going to see a large loss, because in the big scheme of things, the most I could ever lose, that's not true. 99.9% of the time, the most I could ever lose is 1%. You could have a big gap down you can't defend against, but it would have to gap down more than 2 times. And sometimes it's happened, but most of the time your maximum allowed loss is going to be 1%. But that's only going to happen, like I said, about 5% of the time. All right, let's talk a little bit about trader psychology. Today actually may not be so much about trader psychology as it would be some good trading words of wisdom, but there's a little psychology there as well. Look at this little guy with the baseball bat. And I actually picked this one because I've really picked up baseball lately. At 56, I've really picked up baseball. Strange, right? Went out, I got a baseball coach, really enjoy it. I'll tell you, just sitting there and playing catch, something so pure and so great about it. And I have this goal that I want to be able to hit a 100-mile-an-hour fastball, which I've already done quite many times, actually. And I've just been obsessed with baseball lately, I go to the batting cages all the time. I have a little T-ball thing. I hit the balls in my house, the little plastic wiffle balls, but it's really fun. And it, it kind of got me thinking about I'm starting kind of from scratch with baseball, and whether it's sports or trading, it's all the same thing. The expert in anything was once a beginner. Paul Tudor Jones was once a beginner. Warren Buffett was once a beginner. The best traders in the world were once a beginner and didn't know anything about trading. And if that's you, let me tell you, learn properly from the beginning. You know, people ask me, what's your optimal student? Actually, the optimal student that I could have would be someone who's never traded before. Think about golf. If any of you out there are golfers and you're kind of decent golfers, but maybe a little hacky, think about all the bad habits that you have. And then if you went to a pro to help you with your swing, you're going to have to unlearn a lot of bad habits. If you've never golfed before and you go to a pro, then a pro is going to teach you the correct way from the beginning, and you're not going to have to unlearn any bad habits. And that's why my ideal student is someone that doesn't know anything about trading. They don't have any ideas in their head about trading, so that I can teach them the absolute right way to trade. I mean, there's many ways to trade, not just the way I trade, but they all have to do with good risk to reward ratios, rejections of level. So if you want to become an expert in trading, you need to learn a correct process, whether it's from me or someone else, but you could be a world famous trader. You could make your living from trading, but you have to use good trading principles. You need a complete plan. So, one way or the other, learn a complete plan, and that's the way to become a long term successful trader. So, we all have to have goals in our life, whether it's baseball or whether it's trading or relationships or anything else. But you need to create a plan and then follow that plan, and you need to work. You can't just watch the financial news and, oh, well, they said this is something good. You need a complete plan. So, the expert in anything was once a beginner. Find yourself a good coach, find yourself a good trading process, whether in trading, if it's baseball or basketball or violin, learn from someone good and create good habits and work hard. And one day you really can become an expert, even though you're just a beginner at this point. All right. As I mentioned, I have gone down through my watch list, and there are some really good potential trades. They're not there yet. If they were there right now, I probably would have already taken the trade. Now I'm already in Apple, as I just mentioned, because of the return to value V2 still in it, because it's still holding my end of week stop here. But if I was not in Apple, I would certainly be considering looking at this 200-day moving average. See the 200 down here? Historically, buying Apple off of the 200 makes a lot of sense. So right now it's not at the 200, but next week, if it does reject the 200, I would consider getting into Apple, depending on what my weekly trade is. If I have some kind of rejection, a bounce, a intraday rejection where it goes under the 200, closes back above, or it closes back below and then closes back above. But it's rare that you get a chance to buy Apple near the 200-day moving average, and this is what I would be looking for on Apple. Berkshire Hathaway. Well, well, well. Look at this, everyone. Seemed like it would never go down when it was up here, right? Look how high that was. Got to the third ATR channel. 92% of prices, if you get to the positive third ATR channel, that's about it. And that was about it. Now, look, we're near the negative third ATR channel and the 200-day moving average. I really like the 200-day moving average here. I drew a line, the green line at the 200. Now I'm going to look at the higher time frame because it's important to look at higher time frames as well. So I drew the line at the 200 on the daily, on the weekly. Does that dovetail with any levels on the weekly? It really does. Look at the dotted line. This is the 50 EMA. So if the price on the daily gets to the 200, it's also going to get to the important 50 EMA level on the weekly. So I would really be interested in buying Berkshire Hathaway BRK underscore B if next week we get some kind of rejection of the 200-day moving average. Doesn't mean it would be a positive trade, but it would give me a key level to key off, give me a good risk to reward ratio to key off of. Caterpillar, same. Look at this. Look how high it was over here. Everybody had to buy it up there. Not sure why. But here's the 200-day moving average down here. I drew the line, the 200. Let's see what that dovetails on the weekly. Not exactly at a level, but here's the bottom of the -1 ATR channel. That should be some support. Here's the 50 SMA. That could potentially also be some support. But I would definitely consider, if I got a nice rejection at the 200, to consider entering Caterpillar. Dow Jones Industrial. Well, there's a couple levels here that we could look at. We could have a close above the 300, which is the orange line. That could give me a level to key off of. But ideally, I would rather buy DIA or 3568 if we go lower and reject the 30 RSI, because if we do come lower and test this low, I can already tell we're going to have a significant double bottom bullish divergence, probably a RSI divergence and an ATR divergence. That would that's doesn't mean, just because you have these divergences doesn't mean that it's an automatic buy. You still need a signal. But the signal for me, if we go down, would be go below the 30 during the day, back above at the end of the day, or conversely close below the 30, close back above. And I would consider, if it moves up, because sometimes you don't just need things to go down, you need them to move up. If we closed above the 300-day moving average here as well, I could potentially get long DIA as well, but my preference would be an under 30, over 30. NVIDIA, well, here we were at over $500. Now we're at $413. I would definitely consider getting long NVIDIA if we have an under 30, over 30, and dovetailing with the -3rd ATR channel. It's been rare that you've been able to buy NVIDIA on any deep dip buy, but we are getting close, so I would consider that. SPY, well, this is the S&P 500. Look, we closed below the 200. Wow, that's significant. That is significant, and really has to do a lot with bonds as well. The higher the yields go, the more basically the market goes down. So there's two levels that I would look for to key off of SPY. 200-day moving average, of course. If we close back above it, I could consider getting long there using the 200 as my end-of-day stop. Looking at this chart, though, honestly, if we head back down, I would rather buy SPY down here, because if we get all the way down here to this 250-day moving average, we would have a double bottom bullish divergence. We had RSI divergences. We would have ATR divergences. And if we went under 30, over 30, at the same time we went under the 250, over 250, that would be a really good setup. Super good setup. So that's what I'm considering on SPY. Bonds, oof, bonds are brutal. But I'll tell you what, in my opinion, we are getting very close to a bottom on bonds. Why do I say that? Well, this is TLT, by the way. The reason I say this is there's been so much negative press about bonds, and so much fear, and so much panic. But those are the times that I want to buy blood in the streets, right? Bonds aren't going to go out of business, I can tell you that. But look, again, we have a double bottom bullish divergence. Here's our low, deep red. We rally into green. We are now lower than this low. We have less red. That is a double bottom bullish MACD divergence. Here, we were at below the -6 ATR channel. Now we're not quite at the 3rd ATR channel. RSI, look at the lows here. Look how deep these RSI levels were. Now we're lower, they're higher. All big picture, this looks very bullish to me. I know this probably doesn't look bullish to you, but this looks very bullish to me. And look at the volume, everyone. This is the highest volume I have seen in bonds. And the reason I bring up volume is because when you get huge volume, I mean, look at the volume over here. Look at the volume here. To me, all that means is there's a lot of a lot of people selling, but a lot of people buying this as well. And I believe the strong hands are buying TLT right now, and the weak hands are selling. So right now we're at a 33.69. We did close back over the negative third ATR channel on Friday, which is a decent sign, but it's not enough for me to buy. And under 30, over 30, I would definitely consider getting bonds, especially in the broader context of the double bottom bullish divergences, the RSI divergences, the ATR divergences, the heavy volume, and the negative sentiment as well. And you can see I drew these trend lines here. Here's a low, here's a low. I'm drawing the trend line out. We definitely could get down here probably to about $80, $81, but there should be some support at that trend line in that channel as well. But as far as just following the rules, an under 30, over 30, I would consider getting into the trade. Tesla, wow. Well, look at this. We closed below the 200-day moving average. Pretty incredible. After being way up here, now we're down here. Two options on Tesla next week for me. Possibly a close back above the 200, I would consider getting long. Or if we go lower and we reject the 250, also a consideration as well. Me personally, I always like the lower level. But either way, if we go higher and close above the 200, I would consider getting long Tesla there. If we go lower, reject the 250, I would consider get long there. And then real estate. Well, real estate has come down. Of course, it's coming down with bonds. By the way, bonds is pretty much going to dictate everything. If we see TLT go up, that means yields are going down. That will be good for the market. If we see TLT prices going down, that means interest rates are going up. That's going to be bad for the market. And bonds have been going down, so of course real estate is going down as well. But look at this. We have not quite tested this low here. But look, here's the low, deep red MACD bars, lots of selling pressure. We had a nice little rally, got to green. Now we're almost as low as here. Look, just barely a little speck of red. All this means from a MACD perspective is that the selling momentum, even though it looks strong from a MACD perspective, is getting weaker, and the implication is we're running out of sellers, then we move back up. So again, the double bottom bullish divergence, the ATR divergences, the RSI divergences, these do not mean that I'm going to just buy because these are happening at the moment. I still need a trigger. The trigger for me, about the only trigger right now, would be an under 30, over 30. During the day, it goes under 30 but closes back above, or it closes below 30, closes back above. Of course, a V1 or a V2 in there would add to the credibility of the market. So real quick recap on Apple. Some kind of rejection of the 200-day moving average, I would consider getting long Apple. Berkshire, some kind of rejection of the 200, I would consider getting long Berkshire. Caterpillar, some kind of rejection of the 200-day moving average, I would consider getting long Caterpillar. The Dow, DIA, two options. We go lower, a rejection of the 30 RSI, or if we go higher, a close above the 300-day moving average. NVIDIA, rejection of the 30 RSI channel, ideally with a rejection of the negative third ATR channel. SPY, two options, close back above the 200, or if we go lower, rejection of the 250, or if we go really lower, rejection of the 300. TLT, some kind of rejection of the 30 RSI. Tesla, two options on this, close above the 200, one potential. If we go lower, rejection of the 250, that would be the second. And then last but not least, again, XLRE, rejection of the 30 RSI. Now, we have 9 symbols here. It's theoretically possible that all of these signals on Monday could trigger, right? Unlikely, but it is possible. Does that mean that I would get into all of these positions at once? No. I like to take the very best signal, or in other words, I basically only take one trade per day. I don't care if all 9 of these signals happen. I'm still going to narrow it down to the best one. And how do I narrow that down? Well, how many confluences of signals are happening? If one stock has an under 30 over 30, but another stock has an under 30 over 30 and under 200 over 200, and it has a V1 and the relative strength's great and the higher time frame looks better, then I would pick that one. So every little signal it has, I give it a little, we give it 1 point, for example. And if one stock has 1 point, but another stock has 5 points, of course, I'm going to go with the one that has the higher score. It just has a higher score. Doesn't mean it's going to be a positive trade, but it's more likely to be a positive trade. And again, these are the things, these are the devils are in the details. This is what I teach in my one-on-one courses, how to narrow down to the very best trade. All right. So those are the daily potentials. Let's look at the weeklies. I only have 3 of them. Here we go. Now again, weeklies close on Friday. So we had earnings on Morgan Stanley, big down move on the daily. But what am I looking for here? Well, 2 potentials. We close below the 200-week moving average. That's a key level. Close below. Close back above, I would consider. Ideally, I'd like this to come down to the 250-week moving average, reject that. Come down to the 300-week moving average, reject that. Or potentially a rejection of the 30 RSI. We're at a 34.39. We're not quite there yet. So a lot of options on Morgan Stanley. Either a close above the 200. If we go lower, a rejection of the 250. If we go lower, a rejection of the 300, or a rejection of the 30 RSI level as well. SSO. SSO is double leverage SPY. Well, what jumps out to me right this moment, of course, is the 200-week moving average. Some kind of rejection next week at the 250, the 200-week moving average, I would consider getting long SSO. And then Tesla, we talked about Tesla on the daily. There's some key levels coming up, but there's also some key levels coming up on the weekly. Look, see how we have the 50-week moving average and the 200-week moving average, and they nested right here. Tesla had earnings. They weren't so hot tamale, as you can see. Another good reason why not to hold through earnings. But I'll see about Tesla whether or not we get some kind of intra-week rejection of the 200. Doesn't mean it's going to be a positive trade, but again, it gives me a level to key off of. So real quick recap, Morgan Stanley, potential close above the 200-week moving average. If we go lower, rejection of the 30 RSI or rejection of the 200 or the 300-week moving average. SSO, about the only thing right now would be a rejection of the 200-week moving average. And Tesla, possible rejection of the 200-week moving average, or if we go lower, rejection of the 250 or the 300. And again, if these all triggered on the same day, doesn't mean or on next Friday, if these all trigger because they're weekly trades, doesn't mean I would get into all of them all at the same time. I would pick the one that has the best score, or in other words, the one that has the most confluences, combinations of indicators. So, hey, by the way, if you're enjoying this podcast and you're learning something and you find it valuable, I would really appreciate it if you could hit the thumbs up button. It really does help out the channel, lets YouTube know that there's some valuable content here, and it would really help the channel out. So appreciate that. I spoke at the beginning of the podcast about how I do teach private one-on-one lessons in the evening time via Skype. If you really want to learn how to trade, if you really want to learn a new skill, if you want to learn it from someone who's traded for 28 years and been through all the markets, send me an email. Love to have you as a student. I love to teach. I really like hearing back from my students that they were so glad that they took the course. The course is 15 hours. Each session is 3 hours, and then I teach 5 sessions. We go through all the 5 different trading approaches that I use. I teach you step by step. We do all sorts of simulation trades. It's not an easy course. I ask a lot of questions. We do a lot of simulation. I throw a lot of curveballs at you to make sure that you're learning this. And by the time you're done, you will be a better trader. It does cost $1,750 for the course, but to have a one-on-one instructor, really, is the way to learn something. Whether you're learning guitar or violin or trading, having a one-on-one coach that teaches you exactly step by step really is invaluable. And that's the way that, and that is the reason that I offer the one-on-one, because I really think it's the best way to learn. So my email's in the link in the description. Feel free to send me an email. We can get a Skype call, talk a little bit about things, but I know you'll enjoy the course, and it is an investment in learning a new skill. If you're not in a financial position to be able to take the one-on-one course, I do have a very affordable online course available at udemy.com. The link's in the description. That particular course, I teach you the deep dip buy stock trading strategy, which a lot of what I've talked about today is the deep dip buy stock trading strategy. The course only costs somewhere between $12 and $15. There are 26 videos. There are 15 study guides. I believe there's 9.5 hours of video. And in that course, I teach you step by step everything that you need to know about how to trade the deep dip buy approach. And I've gotten so many good reviews and sold so many of those courses around the world. So if you're not, like I said, financially in a position to take the one-on-one course, then this is a really great place to start with the Udemy online course. So I hope you learned something today, everyone. I always like to leave off with, if you could go out and do something nice for another human being today, it really would make the world a better place. If you could also go out and do one nice thing for an animal today, they would appreciate it. We appreciate when someone does something nice for us, and animals do as well. And if we all went out and did one nice thing for an animal, one nice thing for a human being today, it really would make the world a better place. And based upon what's going on in the world right now, I think we could use a little happiness and some nice acts of kindness as well. So again, if you like the podcast, I'd appreciate it if you hit the thumbs up button. I appreciate you being here today. I hope you learned something. Hang in there. I know the market's been tough. Follow your process. Get out when your signals tell you to get out. Be careful, because it is volatile. But don't fear. At some point, this market is going to turn back around, and you'll probably look back and go, "Oh, I wish I would have bought down there." Right? You probably will. But again, you have to follow your signals, follow your stops, all that kind of stuff. So God willing, I will see you next week. We'll see what happens between now and next week. Hopefully it's good things. And hopefully things in the Middle East, we can get some of that stuff resolved, because it's pretty ugly over there right now. And I feel bad for everyone involved, especially the civilians. So anyway, if you have any comments or questions, please feel free to put them in the comment section. I'll do my best to get back to you. And thanks so much for being here. And on the way out, I have to run the U.S. legal disclaimer. Take care, everyone. And thanks again for coming. Appreciate it. Bye-bye.
U.S. government requires options, futures, and forex trading is not appropriate for everyone. While there is a potential for large rewards, there is also a substantial risk of loss associated with trading. The material in this video or live broadcast is not geared towards any particular individual or to any particular financial situation, and is not intended to meet the particular investment objectives of any viewer. This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Any and all information contained in, implied, or referenced by this video or live broadcast is not to be construed as investment advice, and no representation is made that any individual or entity involved in production of this video or live broadcast is an investment or financial advisor, or is registered or authorized to give any financial advice. We are publishers and educators only. Therefore, the various producers of this video or live broadcast will not accept liability for any loss or damage of any kind which may arise either directly or indirectly out of the use of any of this material, including any loss of profit. No representation is made that any account or investment will or is likely to achieve the profit or losses demonstrated. We recommend consultation with a licensed and qualified professional before making any investment decision. This video or live broadcast is not to be construed as an offer to buy or sell any security, financial instrument, or financial product of any kind. Notice is hereby given that any individual or entity involved in production of this video or live broadcast or their clients may have an interest in any security, financial instrument, or financial product mentioned or referenced. Any simulated or hypothetical performance result depicted does not represent actual trading and therefore may under or overcompensate for the impact of various market factors such as lack of liquidity. Thank you.